The BRRRR strategy has built more small investor portfolios over the last 10 years than just about anything else. So you buy a distressed property, rehabilitate it, rent it out, refinance out your capital, and repeat. It worked because it allowed investors to recycle the same money into multiple deals. But that version of the BRRRR that, as most people learned, designed for 3 and 4% interest rate environment, rates aren't there anymore. They're at 6.5 or more. And a lot of investors who tried to run the old playbook in the current environment, they got burned. So today I'm going to show you what the BRRRR strategy looks like in 2026 and why it still works when you rebuild it around the right numbers. If you're new here, like the video, hit the subscribe button and the notification bell. No fluff, no hype, just real estate investor contact. I spent 35 years in the United States Air Force, 13 years as a police officer. I served as the mayor of Cinnaminson, New Jersey. I'm an active real estate investor focused on single family and multifamily properties. I founded a low-cost investor-focused property management company, and I mentor veterans and first responders who want to get into real estate. Look, here's where investors go wrong with BRRRR right now. They start with the property instead of starting with the numbers. They find a distressed house they like, they estimate the rehab, then they try to work backwards to justify the purchase price. That process worked when rates were low enough that the margin for error was ridiculous. But at 6.5%, the margins are too thin. When you build your deal from the emotional attachment, you're going to end up buying properties that not only are never going to cash flow, you might lose money. Then you can't refinance out of them because the after repair value doesn't support the loan amount that you need. I watched an investor recently go through this exact process in the last 18 months. Found a duplex, looked great. Distressed seller, below market condition, solid location. Ran the rehab at $40K and then bought it for $130. Put his own cash in, did the work, got it rented, then went to refinance. The appraisal, the after repair value, came in lower than he projected. The bank would only lend him 75% of that value, not 80. So he couldn't pull out enough to cover what he had in the deal. His capital got locked into the property. He couldn't repeat it. The strategy will stall because your numbers never actually worked from the start. He liked the deal before he analyzed it, and that was the mistake. BRRRR requires 3 things to work: a purchase price low enough, an after repair value high enough, and a rental rate high enough to cash flow after the refinanced mortgage is in place. At 6.5%, all 3 of those variables, they have to be correct. Not close, correct. One bad assumption is going to break your whole model. Look, if you're a veteran trying to get into real estate, join a real estate community built around the discipline and execution, check out the War Room with David BRRRR. That's where serious military investors operate. That's why I've been a member since December of 2019. Hey, for direct coaching, you can find me at buttevans.com. I don't have a program. It's not a sales pitch. So here's how you rebuild the BRRRR for your current rate environment. You start with the rental income, not the property, not the purchase price, the rent. Step 1, find out what properties like yours rent for in your target market. Don't project what the rents might be after you renovate. Find out what they actually are right now for a comparable property in good condition. That's your ceiling. From that rent number, calculate the maximum mortgage payment that's going to allow you to cash flow. Look at a DSCR at 1.25 as your floor. If your property rents for $1,800 a month, your mortgage payment includes taxes, insurance, it shouldn't exceed $1,440. That's the ceiling for your debt service. Work backward from that, and then find your maximum loan amount at 6.5%. Step 3, from the maximum loan amount, calculate your required after repair value. Most lenders are doing cash out refinances, and they'll lend you at 70 to 75% of the appraised value. If you need to pull out $120,000 on the refi, your after repair value needs to be at least $160,000 at 75% loan to value. Step 4, subtract your rehab costs from your required after repair value and get your maximum purchase price. If your ARV needs to be $160,000 and your rehab is going to cost you $35,000, your maximum all-in cost is $160,000 times 0.75 minus your rehab. That gives you the highest number you can pay and still be able to pull your capital out at refinance. If the property you're looking at costs more than that number, guys, walk away. That's the discipline that you need here. That's the system. There are no exceptions. Now, here's the part most people miss. Small multifamily changes this math significantly. On a duplex, your gross rent might be $3,200 a month across 2 units instead of $1,600 on a single family. Your cash flow ceilings go up. Your DSCR is easier to hit. And the appraised value on a small multifamily is partly driven by the income it's going to generate, which means a well-rented duplex in good condition can appraise higher than a comparable single-family home. That gives you more wiggle room on the refinance. The markets where BRRRR still works at current rates tend to have lower median home prices combined with solid rental demand. That price-to-rent ratio is the starting filter. If you're shopping in markets where $350,000 property only rents for $1,800, the math doesn't math here. And if you can find markets where $150,000 properties rent for $1,600, now you have room to operate. Do your geographic research before you do anything else. Become a subject matter expert in your area. One last point here. Your rehab estimate has to be accurate. Investors consistently underestimate rehab costs, especially on older properties. If you think the rehab is going to be $30,000 and it comes in at 48, you broke your model. Before you make an offer, walk the property with a contractor, not after. Add 15 to 20% contingency on whatever the contractor quotes. If the deal still works with that contingency, it's a good deal. If you need the contingency to disappear to make the numbers work, it's not. So as always, here's a checklist that you can use to BRRRR in 2026. Number 1, start with market rents, not the property. Know your comparable units' rent before you analyze anything else. Calculate your maximum monthly debt service using a 1.25 DSCR on expected rent and make that your ceiling. Back into your required after repair value from the maximum loan amount that you can service. And subtract the rehab costs from 75% of the after repair value to find your maximum purchase price. Don't pay more than that number. Walk every property with a contractor that you trust before you make the offer, and then add 15 to 20% contingency to every estimate. Next, prioritize small multifamily. Those income stacks will work faster and the refinance math is more favorable than a single-family home in most markets. Look for markets where the price-to-rent ratio gives you room to operate. Low-median prices with a solid rental demand is really the filter here. If your numbers don't work at today's rates, just walk away. Some of the best deals I've ever made were the ones I walked away from. The system only works here when the system is followed. BRRRR is not dead, but it requires more precision and more discipline than it did 4 years ago. The investors running it correctly are still pulling capital out and buying the next deal. The ones who skipped the math are stuck. If this helped you out, do me a favor. Hit the like button, subscribe to this content, hit the notification bell, and share this with your friends. I do new content every week. Thanks for watching. I'm Bud Evans. Aim high, execute fast. See you on the next one.